The biggest mistake traders make is trying to identify an inducement before it's confirmed. Let me show you the 5 rules that almost nobody talks about. But first, you need to understand what an inducement really is. Imagine the market is trending higher and creating higher highs and higher lows. Along the way, it forms small swing lows. Most traders see these levels as good buy entries or places to hide their stop losses. But large players know exactly where those orders are sitting. Before price continues higher, it often drops below those swing lows to grab that liquidity first. That's called an inducement. An inducement is a move designed to lure traders into a predictable action. As more traders enter or place stops around the same level, liquidity builds up there. On the chart, it usually appears as a small swing high or swing low before the real move. Price returns to that level, sweeps the liquidity, and then continues in its intended direction. Remember, an inducement is not the target. It's the bait the market uses to collect liquidity before the real move begins. So that's what an inducement is. But here's the real question. How do you spot an inducement before it happens? It comes down to 5 simple rules. Rule number 1. The market is hunting liquidity, not higher lows or lower highs. Many traders think higher lows matter because they're part of market structure. But smart money isn't interested in the higher low itself. It's interested in the liquidity below it. In an uptrend, traders often place their stop losses below the latest higher low. As more stops gather there, liquidity builds up. Before continuing higher, price will often dip below that level, trigger those stops, and collect the liquidity. Then the real move begins. Remember, the market doesn't hunt higher lows. It hunts the liquidity below them. Bigger sweep doesn't mean bigger liquidity. Rule number 2. The market usually takes only as much liquidity as it needs. Many traders expect every liquidity grab to make a deep move below a higher low, but that's not always the case. If enough liquidity is sitting just below a level, price may only dip slightly, trigger stop losses, and quickly reverse. If that sweep isn't enough, price may continue lower until it finds more liquidity. That's why some liquidity grabs are shallow, while others are much deeper. So don't focus on how far price moves. Ask yourself this: has the market collected enough liquidity to continue its intended move? Remember, the market isn't looking for a specific price. It's looking for enough liquidity. Rule number 3. An inducement usually forms after a clear market trend. But why? Because the market first needs traders to believe the trend is real. When traders see a series of higher highs and higher lows, they become more confident and start buying. Many also place their stop losses below the most recent higher low. As more traders do the same thing, liquidity begins to build there. Without a clear trend, fewer traders are convinced, which means less liquidity for the market to collect. That's why a strong trend is often the first step in creating an inducement. But here's where most traders get fooled. Rule number 4. After an inducement, expect strength. This is what confirms the inducement has worked. For example, in an uptrend, price may sweep below a higher low to grab liquidity. But what matters is what happens next. If it was a true inducement, price should quickly reject that level, show strong bullish momentum, and ideally create a new higher high. That strong move tells you the market has collected the liquidity it needed. But if price moves sideways, struggles to recover, or keeps falling, the sweep may not have been an inducement at all. Remember, an inducement isn't confirmed by the sweep. It's confirmed by the strong move that follows. Rule number 5. Ask yourself this: who got trapped? Every liquidity sweep creates winners and losers. Your job is to identify who the market trapped. In an uptrend, when price breaks below a higher low, many traders think the trend is over. Some close their buys, while others enter sell positions. But if price suddenly reverses, rallies strongly, and creates a new higher high, those sellers become trapped. As they rush to exit their trades, they add even more momentum to the move. That's why you should never call a sweep an inducement while price is still moving down. The confirmation comes afterward. If price rejects the low, traps sellers, and continues in the original direction, the sweep was most likely an inducement. Remember, the question isn't where price swept liquidity. The question is who got trapped.
If this video helped you understand inducements better, hit the like button and subscribe for more trading lessons. Thanks for watching, and I'll see you in the next one.